Amortisation. This is just a very big word accountants use to confuse everyone. So let's just explain what it really means. This is relating to large costs that you put through your business. Not of £100, £200 or £1,000, it's probably £10,000, £20,000, £30,000. So let's say this is a training course that you're buying for all of your employees, and let's say it's that £30,000. What HMRC will say is that you can claim that as a cost, but the reality is you're not going to see the benefit of that expense for a long time. So they expect you to try and claim it over a longer time frame. So ordinarily, if you had a high expense or an expense in a year, it goes through your profit and loss account and just says, I've had £100,000 income, I've spent £30,000, I'm taxed on £70,000. Amortisation seeks to spread that cost. So let's say that HMRC think that this is something that is more of a 5-year spend. So again, if we look at it, rather than it being in year one, you get £30,000, if you've got it over 5 years being your last year here, what HMRC will say is you can claim that money each and every year, but you would be claiming £6,000 against your business revenue. So you're reducing your profits and increasing your expenditure, but in a linear fashion, so in a longer term stretch period. So each year, instead of having £30,000 in the year accounts in day one, you'll have £6,000 of allocated expenses over 5 years. And the revenue do this just to ensure that you're not hiking your costs up in year one and then burning the business down in year two. That's amortisation.